Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. All right, the document we are looking at today is titled U.S. Market Peripheral Notes, dated March 26, 2026. This video presents a direct informational narration of the source document. And just a quick note before we dive in, this document is for informational purposes only and does not constitute investment advice. As always, investing involves significant risk. Okay, so here's our roadmap. We're going to break this analysis down into 6 main parts. We'll start with the big picture market overview, then we'll dig into the geopolitical catalyst that really kicked things off. From there, we'll look at political intervention, the macro financial environment, sector performance, and we'll finish up with some technical analysis and a look at individual stocks. So let's start with the market overview. And really what we're talking about here wasn't just a down day. The 3 major indices were showing clear signs of panic selling. This was a classic systemic risk washout. On March 26, 2026, U.S. equities just completely washed out. The Nasdaq Composite got hit particularly hard, falling more than 2%. And it wasn't a quick dip either. It closed right near its lowest point of the day, which tells you the selling pressure was relentless. But amid all that chaos, something really interesting happened with Apple. It basically became the last safe haven. And this is a huge deal for 2 reasons. First, it shows a massive reset in valuation logic. The market stopped chasing dreams and ran toward the certainty of Apple's cash flow. And second, it signals a major confidence breakdown. I mean, when everyone piles into a single stock for safety, it shows a deep lack of faith in everything else. So what was the trigger for all this? The immediate catalyst was geopolitical. We're talking about a combination of sovereign fund liquidity stress, all driven by a sharp escalation in conflict. And you can see from this timeline just how quickly things spiraled. It began with airstrikes on Tehran, which was followed by a successful decapitation strike on an IRGC naval commander. That, in turn, led to missile retaliation directed toward Israel. It was an incredibly rapid sequence of events. So the core driver here was that major sovereign funds in the Middle East suddenly faced really tight funding conditions. This forced them to start liquidating assets, and that selling ultimately drained a massive amount of liquidity from the U.S. stock market. And then came an institutional warning that just threw gasoline on the fire. Axios reported that the Pentagon was actively preparing for a major Middle East war. As you can imagine, that sent institutional risk aversion through the roof, leading to an aggressive exit from equities. Next, let's look at the role of political intervention. In this case, the source points to the White House's own narrative manipulation as a direct catalyst for the market's volatility. There were essentially 4 key actions. First, the White House shattered any hopes for a ceasefire. This caught trading algorithms off guard and caused their positioning to fail. Then, there was a signal that the market's decline hadn't reached a threshold for intervention. And finally, the White House reframed its strategy, which was widely seen as a move to buy time for military mobilization. And here is the exact quote that Wall Street seized on. President Trump's response to the market drop was that he thought it would fall even more. For traders, that wasn't just an off-the-cuff remark. It was interpreted as a clear signal that the so-called put was not in play yet. The decline had to get worse before any support would be considered. All right, moving away from the headlines, let's talk about the macro financial environment. There was a powerful underlying force at work here, which the document calls the fundamental gravity of U.S. Treasury yields. And that gravity was getting stronger. The 10-year U.S. Treasury yield climbed up to 4.4%. That's a critical level, and it put immense pressure on the market's valuation models, especially with jobless claims data remaining stable. So this all led to a major shift in the consensus view of the Fed's policy path. The market fully priced in a higher-for-longer interest rate regime. All those previous expectations for rate cuts were completely taken off the table. Okay, let's look at how this all translated to sector performance. With risk aversion this high, we saw a collective repricing across some of the market's hottest areas, including semiconductors, AI, and even precious metals. And you can really see the damage in this table. Semiconductors saw a significant drawdown. The memory sector also took a big hit. But what's really telling is the performance of precious metals. The fact that even gold was liquidated points directly back to those sovereign funds being forced to sell whatever they could to raise cash. And here's an interesting side note, what some traders might call a reverse indicator. JP Morgan had recently made some constructive calls on both gold and equities. Well, those calls were immediately hit by a sharp reversal. When a major player's hedging strategy fails that spectacularly, it's a pretty strong sign of just how disorderly the volatility is. Now let's dive into the technical analysis and a few specific stocks, because the chart patterns here really validate that this was a deep market redirection, creating something of a strategic vacuum. From a purely technical perspective, the picture was ugly. The market formed a bearish Marubozu-type candle, which indicates intense selling pressure from open to close. The S&P 500 decisively broke below its 5-day moving average. The analysis at the time pointed to an expected breakdown on Friday, and the recommended strategy was simple: capital preservation until at least April 6th. Turning to a specific stock, Meta found itself facing a serious systemic regulatory risk. A court ruling came down on the issue of social addiction, and it crucially established legal responsibility for mental health harm. This is a huge development as it creates the potential for a claims black hole for the company. And this comparison table of the big mega caps is very revealing. For Google, the issue seems to be a technical and cyclical downturn. Microsoft, however, presents a more concerning picture, with a potential break in its long-term secular trend. And then, as we've discussed, you have Apple's relative strength, which really confirms that flight to safety and cash flow certainty. The document's summary really captures the entire situation perfectly. It says, in a bull market, the premium is from dreams. In this dislocated environment, the market recognizes only cash flow and certainty. Cash remains the most efficient defense. And we'll end with the professional risk disclosure and important notice. This document is for informational purposes only and is not investment advice. All decisions are at the reader's own risk.